Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because we finally made it to September, which means we're officially 75% of the way through this painful and boring Bitcoin summer chop period that we've been in since the beginning of June this year. And I'm sure you've seen the content all over Twitter and YouTube of how September is the worst month for Bitcoin historically. So it's no surprise we've had a red start to the month already, but what most people fail to mention is that this seasonality is likely entirely driven by the fact that September is the worst month for the S&P 500 historically, with a return of negative 0.8% going back to World War II, but even more importantly, a return of negative 2.3% the past 10 years, which makes up the majority of Bitcoin's existence. So it's no surprise that with the correlation we always discuss on this channel between the S&P 500 and Bitcoin, that when the S&P 500 is doing poorly, Bitcoin tends to do terribly, like 2018, March 2020, and 2022. And if the S&P 500 is doing really well like 2017 or 2021 or 2023, then Bitcoin is likely doing incredibly well. And now that we have these new Bitcoin spot ETFs that are quite widespread and have very good liquidity, we would expect this correlation to only strengthen over time as investors with large pools of capital are able to trade those ETFs in the same brokerage where they trade their stocks. So looking at the price action of the S&P 500 and the main drivers of the S&P 500, which right now are very clearly the election, as we are now only 62 days away, and of course the Fed's monetary policy and the market's current expectation for Fed rate cuts with the next FOMC meeting, where the Fed is supposed to have their first rate cut this cycle, being only 2 weeks away. So starting with the election, we know that markets hate uncertainty, and this has been a very close race for quite a while now. The odds keep flipping back and forth, but as long as it remains a close race, I would expect the trend of volatility increasing as we approach November to continue. And if we look at what's been happening with the volatility index over the past few months, we've seen a slow and steady increase ever since June of this year, which is quite in line with our expectations in terms of what we've seen historically in election years as we approach November, but especially because we know that markets hate uncertainty. So it's no surprise that we've been seeing a lot of chop from the S&P 500 and Bitcoin as we get closer and closer to this election. As for the Fed's monetary policy, we know that the first rate cut is expected in September, and the market right now expects a rate cut in almost every single meeting going forward. And of course, that'll change as we get more inflation data and more labor data, but we do know that the market's expectations for Fed rate cuts is the main driver for the US dollar index. It is still getting that bounce off the range low we've been mentioning for a couple of weeks now, and I would expect it to at the very least bounce up to this 20-week moving average, and then we're going to find out there if we're going to get that aggressive rollover into the risk on zone, or if the US dollar index is able to reclaim that level and trend higher. And this is important to us because the US dollar index has quite a strong inverse correlation with Bitcoin historically, in that Bitcoin is able to rally while the US dollar index is consolidating, but it's not able to enter price discovery and its mania phases until we see those large prolonged drops in the US dollar index. And of course, that's also what's been required for our major alt seasons as well. So as long as the US dollar index is still in this range, I wouldn't expect anything incredible to happen with Bitcoin or with altcoins. So as long as Bitcoin remains below its range low at 61.5K, I'm not seeing a lot of reasons to be overly optimistic in the short term. And I still have my normal cycle scenario as my base case, where I'm open to 1 or 2 more large shakeouts between now and the November election. Of course, if we can reclaim 61.5K before then, we can start talking about this other scenario in white where we have a much earlier rally And of course, we're always going to have the failed cycle scenario in the back of our mind, but the normal cycle scenario still makes the most sense to me because I don't believe that rate cuts are bearish for the economy, because I do think the Fed will do whatever it takes to meet their mandate of promoting maximum employment and stable prices. And if we look at their end of year projections for the unemployment rate and inflation, we can see their end of year projection for the unemployment rate was 4.0% and we're already at 4.3, while their end of year projection for inflation was 2.8%, but we're already ahead of schedule at 2.6. So it makes a lot of sense for them to start cutting rates and slowly work their way back to easing. But I do think the fears surrounding the labor market are a bit overblown. We do know that historically, the unemployment rate getting back above its 2-year moving average was a major sign of recession. But when we look at some other data points and take in more information, it doesn't look nearly as bad. For example, this is my favorite proxy for layoffs, the initial jobless claims. And you can see we're still below our cycle highs that we set in June of 2023 when all the big tech companies like Facebook and Google were laying off employees. And we're still well below our recession starting average of around 360,000 initial jobless claims each and every week. So I do think the labor market is still stronger than most people expect. And this is also further exemplified by the continuing jobless claims, which is a really good proxy for the number of people that are currently unemployed. And you can see our cycle highs as of right now are about 1.87 million. And recessions usually start when we're closer to around 2.7 million. So I do think that the unemployment rate is making investors panic a little more than they should be if they were to look at the initial jobless claims or the continuing jobless claims and not just the unemployment rate. So since we have the unemployment rate above the Fed's target and we have core PCE below the Fed's target, I think these rate cuts are coming at a very good time, and not because everything is breaking and everything is collapsing. And we're going to repeat 2007 or 2001, where the Fed waited way too long to step in and things were already quite broken by then. Something else I haven't seen enough people discussing is the fact that going into 2001, the market rallied essentially straight up for well over 5 years. And same thing for 2008. We rallied in a straight line essentially from 2003 all the way to 2007 before the crash. But if you look at this cycle, I mean, we had a 30% drop in March of 2020 when the whole world shut down. And then we had another mini bear market in 2022 when everybody was panicking over the rate hikes and the yield curve inversion. And we saw quite an extended drop then. So I don't think today is anything like 2007 or 2001, but I'm open to being wrong in that scenario. And of course, I mentioned this in my last video, but this chart continues to blow my mind. I'm not saying that rate cuts have to be bullish. I'm not saying they have to be bearish, but just be careful viewing it as a black and white thing that has to be one way or another. I'm open to multiple scenarios, but I'm seeing way too many people sharing charts like this one where they're saying that rate cuts are going to coincide with a market crash like 2008 or 2001. So of course, we'll continue monitoring it, but I do think this chart paints a very interesting picture that perhaps rate cuts don't always mean that something has completely broken in the economy. And we know that a technical recession is defined by 2 negative quarters of GDP, but as of right now, the Atlanta Fed's GDP estimate is still at about 2%. And if we look at real GDP over the past few quarters, we've been well above zero for a while now, which still aligns very nicely with the Fed's projection for the end of 2024 and 2025. So I don't think it's time to panic quite yet. And I do think these types of charts are quite misleading, and it's going to be a very painful few months for a lot of investors if they rely too heavy on this theory of rate cuts coinciding with market crashes, especially because of what the federal government is doing with their deficit and how much money they're spending before the economy even enters recession. In previous cycles, deficits would be used to pull the economy out of recession, especially in 2008 and in 2020. But if we look at this cycle, we've been in deeper and deeper deficits for a while now, even before the economy enters recession, which is why I find it very hard to be incredibly bearish in the short term when you have this type of debt expansion that we've seen over the past 2 years, and the fact that risk assets have been doing incredibly well, even though money supply is down since mid 2022 and looks to be curling its way upward before it starts catching up to where the US government debt has gotten to. And my two favorite visualizations for this are showing the relationship between the national debt and the S&P 500 and how we get steeper and steeper increases in the US national debt alongside steeper and steeper increases in the S&P 500. And my second favorite visualization is the S&P 500 divided by the M2 money supply, so we can account for the M2 money supply when looking at the S&P 500. And you can see that although we are quite a bit more overvalued than 2021, 2019, and 2007, this is still nothing like what we've seen previously with the dot-com bubble. And I do expect M2 money supply to start increasing aggressively over the next 12 months. And it will be incredibly interesting to monitor this chart as the M2 money supply starts increasing, because I do think that is the main driver of the S&P 500 and Bitcoin. And because the US M2 money supply has been relatively flat for a year and a half, we don't see a lot of difference between the Bitcoin divided by M2 chart and the regular Bitcoin USD chart. But once we start seeing that M2 money supply expansion, I would expect that to really send Bitcoin flying when we really see that currency debasement coming back. But it's hard to know exactly when that's going to happen. But the Fed beginning to ease once again and start cutting rates is the first step of that process. And of course, we'll continue to monitor it as we go forward. But for now, Bitcoin's still below its range low, so we're going to remain patient. As for the S&P 500, still chopping around, which makes sense with this election year seasonality that we see as we approach November. So it's hard to know exactly how low Bitcoin will go. I'm open to the low 40,000s for one last major shakeout, but I don't think it's likely to happen. And of course, the more unlikely the scenario, the better the buying opportunity, in my opinion. But for now, it doesn't look like we're going to see those prices, but I'm definitely open to them if they do happen. And I still consider Bitcoin to be in a fair value range. Not interested in doing any selling as long as we're below 70K, and not interested in doing any buying as long as we're above 50K, because I already have an allocation I'm happy with. So we'll just have to wait and see which one ends up coming first. I would prefer that we visit the undervalued region first so we can load up some more. But if we don't get it, we will just ride to higher prices with our existing positions. And as I'm sure you're all well aware, I still think Bitcoin is in one huge reaccumulation period in this yellow box, like what we saw in 2020, 2016, and in 2012, before aggressive currency debasement kicks off once again. And of course, that's why I remain bullish Bitcoin in the long term, just like I remain bullish on the S&P 500 in the long term. But of course, we have to try and manage our emotions during the volatility along the way. And I only expect that volatility to increase as we approach November and as we see the Fed begin to cut rates. But as for the rest of the week, we do have some very important labor market data tomorrow, which I'll make sure to cover in my next video. And we finally get an update to the unemployment rate on Friday. Our last print was 4.3, the expectation is 4.2, and I would expect markets to react based on what the print ends up being. But anyway, let me know what you expect for Bitcoin and for markets as a whole. Would love to hear from you. As always, thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.